Welcome students. Today we are about to start our unit 2, which is a very important unit because it discusses the 5 heads of income, that is income from salary, income from business or profession, income from house property, income from capital gains, and the last category, that is income from other sources. We have already studied the basic about these topics, that they are given under which section and what does they refer to. Here now in this unit, what we need to do is that we need to discuss each and every head in detail, and we can expect numericals even. Many a times a numerical has been given in exam from head salary, from house property, from capital gains. So we need to see how to assess the income, or you can say taxable income, under various heads. So let us begin with the first head, income from salary. Let us see certain important concepts before moving towards the assessment, and let us try to understand that what salary is. See, it is a form of periodic payment which is given by an employer to an employee. So the first foremost thing that is required for these periodic payments is that there should be a relationship of employer and employee, which may be specified in some employment contract, depends on the case as it would be. See, it is a fixed amount of money which is agreed every year as pay for an employee, and it is usually paid directly in his or her bank account every month. But there are certain things that we need to consider. First, that wages are treated just like salary. Wages and salary, if you have differentiated these two terms till now, you understand the difference as that wages are paid casually, means they may be paid on daily basis. They may change, the amount may change on daily basis. It may be some amount for a week and may change after a week. But as compared to it, salaries are given after every period, in general monthly basis. So here what you need to see, that wages are treated just like salary and are taxable on the same basis as salary. As per section 17 subsection 1, salary includes all of these. It includes the wages, it includes any annuity or pension, any gratuity. You will be understanding the meaning of these. Gratuity is something that you get at the time of your retirement, and the minimum requirement for receiving this retirement benefit is that the period of service should be in continuation of, for a minimum of 5 years. Further, any fees, any commission, perquisites, this is a new term for you, perquisites, these are the additional benefits. We will be understanding the meaning of perquisites and what advantages are called as perquisites in detail in the upcoming lectures. Any profits in lieu of or in addition to any salary or wages that a person is receiving, any salary received in advance, any payment received by an employee in respect of any period of leave not availed by him, that we call as leave encashment. If a person is given leave and he is not availing that, and he is working on those days on which he could have availed leave, then he receives certain payment, and that payment is also treated as salary. Employer's contribution to any recognized provident fund in excess of the 12% of the employee's salary, and the interest credible to recognized provident fund in excess of 9.5% per annum. So these are certain things that we call as salary. These are certain parts of salary. See, why these points are mentioned under section 17 subsection 1? To remove the confusion that whether these additional benefits received from the employer would be taxable or not. We do have provisions, because some of them has certain exemptions up to certain limits that we will be defining in later parts, but at this moment you must understand that these all are considered as salary and are taxable on the same basis as salary is being taxed. Okay. The aggregate of all the sums that are comprised in transferred balance of an employee who is participating in a recognized provident fund to the extent to which it is chargeable to tax. This I just informed you that regarding recognized provident fund and the others as well, it is treated as salary and taxable salary to the extent to which it is available as per the different sections. Beyond this, we have one more part of salary, that is all contributions made by the central government or any other employer in the previous year to the account of an employee under a notified pension scheme. Means if an employee is receiving pension, that also comes under salary only, referred to in the section 80 CCD. So these were the few points that are considered as parts of your salary. Few are mentioned on this page and two you can see are mentioned on this part. See, all these incomes taken in gross salary after consideration of all the deductions under section 16. There are two deductions under section 16. One is the deduction for entertainment allowance, and the second is deduction on account of any sum which is paid towards tax on employment. Then further, let us try and understand that what is the basis of charge for income from salary as per section 15. As per section 15, we have certain income that are chargeable to income tax under the head salaries. Now let us try and understand that what is the basis of charge. See, any salary which is due from employer or a former employer to an assessee in the previous year, whether paid in that year or not. See, in the current time, you must have heard that many people are not getting their salaries due to the unavailability of funds with the employers. In that case, even if the employer is not able to pay the salary, the full salary, suppose employer is paying only 50% salary, an employee who is getting a 30,000 salary in the normal run in this pandemic, if suppose they are getting only 15,000 as salary, only 50% is being issued from the employer side. In that case, even as per the basis of charge of section 15, it says that if the salary is due from the employer, due is 30,000 per month. If it is paid in that particular year or not, it becomes taxable. It is not taken care of whether the person has received that salary or not. If the salary becomes due, whatever is supposed to be received from the employer, then it becomes payable accordingly. Any salary paid or allowed to an assessee in the previous year by or on behalf of an employer or a former employer, though not due in that previous year or before it became due, means if you are receiving anything in the form of arrears from past, or if you're receiving anything in advance, that also becomes taxable in that particular year itself. The same is also again mentioned. Any arrears of salary paid or allowed to him in the previous year on or behalf of the employer or a former employer, if not charged to income tax in that earlier previous year, then it would be charged. If it has already been charged in the previous years to tax, then obviously it will not be double taxed. No double taxation is there in such cases. These arrears are considered for taxation purpose only and only if they have not been charged to income tax in that particular earlier previous year. Otherwise, it won't be. Now, let us see certain basic rules which govern salaries. These are certain things that you need for your own understanding. Maybe that it won't be asked in exam that what are the certain rules that govern salaries. But in that situation, it becomes necessary for you to understand that what actually necessities are to call any income as salary. See, first I told you in the beginning only, there should be an employer-employee relationship, because that defines the salary. Because if there is an employer-employee relationship, obviously there would be an emolument. There would be some services which are being provided to the employer, and in return the employer would be paying certain amount to the employee. Then second important part is the place of accrual of salary. See, according to section 9 subsection 1 of the Income Tax Act 1961, salary is deemed to accrue at a place where the service for which it is paid. Place of accrual is very important to define the income as foreign income or Indian income, because the place at which the services are being provided is considered as the place of accrual. Salary accrued in India is deemed to accrue or arise in India, though it has been paid outside India. No issues regarding that. Now, due date of salary, as per the rules, let us see. For government and semi-government employees, the salary is due on the very first date of the next month. So, suppose the salary of February is due on 1st of March. So, for this purpose, the previous year's salary will be from 1st of March to 28th February of the next year. Okay. For employees of bank and non-government organizations, the salary is due on the last day of the same month. Means the salary of February is due on the 28th of that particular month. So for that purpose, the previous year's salary will be from 1st of April to 31st of March the next year. It's quite simple. Due date for the case of government and semi-government, it is the next day of the where the month ends, means the first date of the next month. On that day, the salary of particular previous month is considered as due. Whereas in case of bank and non-government organization, it becomes due on the very last day of that particular same month itself. Now let us see that how advance salary is considered in such connection. See, it is a common practice of employees to receive salary in advance under conditions of emergency. Tax, because in general employers may not be interested to receive advance salary, and it would even pose a problem for the employees as well if they would be taking something in advance and then at a later stage they may face certain problems to bear up their income accordingly, to bear up their expenses. So tax is chargeable to all the salaries which are due, whether actually paid or not, and also those which are paid, whether which were due or not. Means if you are receiving anything in advance, will also be taxed in this particular year only. So there are two parts here. If it is due and not paid, then only it would be taxed. If it is not due and paid in that particular year, then also it would be taxed in that particular year itself. Let us see further how the arrears of salary are being defined. Although salary is taxable on due or receipt basis, whichever is earlier, but if there are any arrears of salary which have not been taxed in the past, such as the arrears which will be taxed in the year in which these arrears are paid later and allowed to the employee. So these arrears will be taxed in that particular previous year in which these are paid or allowed, although the arrears of salary relate to the past years. So in that particular case, the assessee can claim the relief of income tax under section 89 if so desires. If the no double taxation would be levied in that case. It is the same income, the 12 months salary, if it is received in advance or paid later, accordingly on due and receipt basis, whichever is earlier would be taxed. Foregoing of salary. Once the salary has been earned by an employee, it becomes taxable in the hands, though he may subsequently waive off the right to receive the same from the employer. The waiver of salary by the employee would be treated as application of the income, and salary through though waived would be taxable in his hands. What they are talking about in this, that once the salary has been earned by an employee, so it becomes taxable in his hands. So he may subsequently waive the right to receive the same from the employer. Particularly voluntarily he may waive off that. That is up to him only, but it would be taxed on his part. He would be liable to pay tax on that. What is tax-free salary? When the employee receives tax-free salary from his employer, it normally means that the employer himself pays the tax which is due on the salary of such employee. The amount of tax so paid by the employer is also to be considered as the income of the employee and will be added to his salary if any such income is there for him. Salary paid by the foreign government or enterprises. Salary paid by foreign government or enterprises to its employees serving in India is also taxable under the head salaries unless it is specifically exempted for the ambassadors, foreign ambassadors, etc. under section 10. Unless it is mentioned there, unless it is being exempted, it would be taxed as the normal salaries received by the people. Okay, now let us try and understand another term, allowances. This is a very important part because along with the basic salary, an employee is supposed to obtain certain allowances. See, if we see the dictionary meaning of allowance, It's a fixed quantity of money or other substance which is given regularly in addition to salary for meeting specific requirements of the employees. Along with the salary, it is given additionally some fixed quantity, some fixed amount or other substances just to meet the some specific requirements of the employees. As a general rule, all the allowances are to be included in the total income unless they are specifically exempted. If it is exempted, then only it would not be taxed, other it would be taxed, otherwise it would be taxed normally just like an income, just like the salary. Specific exemptions are there in respect of certain allowances provided under the two sections. We have section 10 13A, that is house rent allowance, HRA, and we have subsection 14 of section 10, that is prescribed special allowances. Now let us see these. These shall be exempt either in full or up to a certain limit, and the balance, if any, it would be taxable and thus would be included in gross salary as per the rules given under section 10. If we see house rent allowance, HRA, let us see what it is. It says that employees generally receive this HRA from the employers, and this is a part of the salary package in accordance with the terms and conditions of the employment. HRA is given to meet the cost of the accommodation where the person is living to provide those services. Obviously, he won't be working 24 hours a day. So he would be working for 8 hours or 9 hours shift, and then he would be taking rest. To give him that accommodation, that particular charge is given to him. HRA is taxable under the head salary to the extent it is not exempt under section 10 subsection 13A, and it would be extent to the minimum of these three amounts. Means these three conditions are there, whichever is the lowest would get exempted as per section 10 subsection 13A. Now let us see these three conditions, what these conditions are, because the least of these would be exempted. First, actual HRA which is received by the employee in respect of the relevant period, the actual amount which is being received from the employer. The next is the excess of rent paid over the 10% of the salary of the relevant period. Means you need to see that 10% of the salary minus the rent paid. Suppose a person's salary is 50,000, so 10% is 5,000. And suppose if he is paying rent as 3,000, then excess is 5,000, that is the 10% of the salary minus 3,000 rent. So excess is 2,000. So we need to consider that amount here. Next is that 40% of the salary, and you need to see that whichever is the lowest amount, minimum of these would get exempted as per section 10 subsection 13A. 50% of the salary is considered in case of the metropolitan cities, Delhi, Mumbai, Chennai, Kolkata, and salary for this purpose would come out as basic plus the DA, means the forming part of the salary for retirement benefits. You will be studying DA in detail in the upcoming lectures. Now let us see some practical aspect that what we have tried to understand. Let us read the question. It is a very easy question, not a very difficult one. And the last part, this is the last slide of today's lecture. See, Mr. Viplav is entitled to a salary of 30,000 per month and a dearness allowance. You must understand that what dearness allowance is here. If it could have been an interactive and a live class, then I could have asked you people that what dearness allowance is, but at this moment I am not having that opportunity to ask you. So I would define that what dearness allowance is, because students till last do have confusions regarding this. This is DA, that is dearness allowance, and it is the calculation on inflation and the allowances paid to the employees, basically of the government sector, public sector employees and the pensioners. Basically, this is given to mitigate the impact of inflation on people. If there is any inflation, so if they to meet the requirements of that inflation, it is given to the employees in order to maintain that inflation and maintain the same standard of living. Okay, let us move further. Let us see the question. Mr. Viplav is entitled to get a salary of 30,000 per month and a dearness allowance of rupees 8,000, and 60% of which forms part of his retirement benefits, and he is entitled to an HRA of 12,000 per month. He actually pays 15,000 for a house in Chennai. Let us see how the gross salary would be computed. First of all, let us see his basic salary. Basic salary is 30,000 into 12 months. For 12 months he will be getting 30,000 per month, so it becomes 3,60,000. Simple. Then comes dearness allowance, that is 8,000 per month into 12 will give you 96,000. He is receiving HRA as 12,000 per month multiplied by 12 months in a year will give you 1,44,000. We need to subtract the exemption which is given as per the section 10 accordingly, the three conditions that we have seen in the previous slide. For this amount 1,38,240, we need to see this working note here. See, DA, first of all DA, let us have a look to that. DA is fully taxable, so no point is there in that. Salary for calculation of HRA would be calculated as 3,60,000, like for the purpose of calculation of salary, because you must have seen that there is a point which talks about the percentage of salary. So how to calculate salary in that context? Here at this point, this one, we are just calculating the salary for the calculation of HRA. His basic salary plus the amount of DA which is forming part of his retirement, means that whole 96,000 we cannot consider, because 60% only is part of the retirement benefit. So we need to calculate 60% of this 96,000, which comes out to be this 57,600. You may check that. So the DA that is forming part of the HRA, that gives his annual salary. So we will not say that his annual salary is 3,60,000. We will say that his annual salary is this 3,60,000 plus the 60% of this, because that is forming the part of retirement benefits. So that comes out to be 4,17,600. Now let us see the three conditions, because the least of these three conditions would be the amount which would be exempted from tax. The first was the actual amount that he is receiving. We have seen that he is receiving 12,000 into 12, that is 1,44,000 a year. Then we need to see that what is the amount of actual amount that he is receiving, the rent paid and 10% of the salary. Rent paid is 1,80,000. How? Because he is paying 15,000 per month as the rent, the actual rent that he is paying. So 15,000 into 12, that is 1,80,000 minus the 10% of the salary. The salary for this purpose is 4,17,600. So 10% of it is 41,760. Subtracting that, we are able to get 1,38,240 as per the second condition. The third condition, that is the 50% of his salary, because he is living in Chennai, which is a metropolitan city, and we are not supposed to give 40% in that case. We have to give 50%. So half of his salary, half of 4,17,600 accordingly is coming out to be 2,08,800. So least of these, the least amount of these, which is the second one, would be exempted from tax. The rest would be taxable. So the actual amount is this, but out of that total we can subtract this 1,38,240, because it will not be a part of your taxable salary. It would be exempted as per section 10 as per the conditions that we have studied. So the gross salary comes out to be this after adding and subtracting these amounts. So you may check that amount. So this would be the amount of salary that would be taxable for the purpose of that particular financial year. Okay. If you have any queries and if you are not able to understand any part thereof that I have explained, then you may contact me. Till then, take care. Thank you.